If you don't put any effort into it, what investing is actually what we would call speculation. It is just throw money into the market. The market's always going to go up.
There's always risk involved in an investment, but you're doing it with some kind of background knowledge about what's happening in the underlying fundamentals. We as Americans have one of the lowest savings rates in the world. It's gone negative at different times, and that might be happening right now. The weird thing about it when you talk about accumulation versus velocity is that the people who want you to accumulate money with them aren't practicing the accumulation theory. They're practicing the velocity of money theory.
They want our money. They want it on a regular and ongoing basis. They want it for as long as possible. And when it's time to give it back, they want to give back as little as possible. You're not going to cancel the insurance on your home or your car. So to do that on your life that is guaranteed to get totaled, it doesn't track.
The reason we think that we should save a high percentage of our income into this vehicle, this whole life vehicle, to kind of pull this all in is because it's going to protect our families in the event that we die. It's going to insure us all the way to the end. The savings never stops growing, and also do the investing side. Good morning, brother. On your end of the world, it's afternoon here.
Yeah, good morning.
Today's November 5th. Not that we're going to follow up with the politics discussion that we published last week, but this one might not come out right away. But here it is, Election Day.
Yeah, it's been interesting. We've got more engagement on that episode. I think I said in the podcast, or at least I said in our little email, probably 98% of people are going to agree with your take on it. And that's probably been what we've seen mostly in the comment sections. And I've got a few messages of people saying that you kind of put into words how I just have this sort of weird feeling about it. And I couldn't really verbalize it, but like I kind of resonate with what you said. But for the most part, I think it's been just about everyone has been in your camp on that one. It's very understandable to be in that camp. It's like I have no thoughts of like, oh, it's crazy to think a different way. Like I totally understand that. But what is crazy is to not question and to not at least arrive at in line with our episode before that about questioning experts. Like it is crazy to just blindly accept. If our audience is in line with the federal government and Hollywood and pro athletes, if we're exactly aligned on something, it should cause you to maybe question it. Maybe you come to the same conclusion that it is legit. But yeah, we are big advocates of questioning everything. And then at least being able to kind of talk through your position without it just being spoon-fed to you. I think that'll help you in all aspects of life.
Yeah, it was fun. I actually got a message from an old friend of mine that goes, we go back to probably 10th grade, 11th grade, something like that, coming up on 30 years. And he asks, because we don't agree politically, but he's a great dude. But he asked me, and he was just like, I feel like I kind of got bait and switched. Like you're when it comes to TikToks anyway, not so much the podcast, but that we're going down this like financial advice world, and then all of a sudden we pull people in with that and switched over to Biden conspiracies. I thought I got a kick out of that. Not our intention. We're going back to normal today. It was just it seemed like a decent discussion at the time, just to kind of go off on a tangent from what we normally do. But yeah, we're going to talk about a little bit more financial principles today, and in particular, saving, investing, speculating, what they are, what they sound like, what it means, and what everybody pushes, and what we should do or should think about, or possibilities of how to think about that differently.
You know, given the nature of how we met, of our kind of how we came to IBC, I think it does tie in a lot of these things, because those were the precursors to how we came around to seeing the financial system the way we do. And so I think that there is a tie-in, even if we're not directly tying it to finances. But to go back to something we said very early on, maybe episode 1, with the intent of this podcast, is we want to convey IBC. We want to teach infinite banking. We want to talk about finances and focus on a different paradigm around capital. But at the same time, there's plenty of podcasts where you can get, the IBC perspective, finances from our point of view, et cetera. And one thing that I always found myself thinking when I was listening to them was kind of dancing around a topic and saying, well, this isn't a political show, or this isn't a show about X, Y, Z. So, we're going to keep our opinions to ourselves. We'll just focus on money, which I guess there's an appetite for that when you're listening to a finance podcast. But at the same time, I remember thinking like, hey, all of your audience is at least skeptical or thinking the same thing. Like, why don't you just say it? And so that was one thing that we talked about early on, was like, we're not trying to just totally filter finance only to the exclusion of everything else. And those 2 episodes felt like things that we were pretty interested in, and they're conversations that we are having regularly anyways. So we thought worthwhile to put in a podcast. But yeah, it'll be mostly finance. Just we'll sprinkle in our thoughts on other stuff from here to there.
Yeah, and Peanut the squirrel, who was murdered apparently this week, is the hot topic on the news, and it goes to show that the government will come after your things. But if your things, money, things being money, are in a secure private contractual vault, they actually can't access that. So back to life insurance, IBC, and financial principles.
Yeah, it's a good place to be right now because either way, whatever happens today, and when you're by the time you're listening to this, whether in a couple days or in a couple weeks, we will know a lot. We'll know the outcome. There'll be weeks and weeks of anger and speculation. It appears like it's going to be pretty tumultuous, and there's a lot of expectations of what might happen in the financial markets.
Yeah. Speaking of speculating, when it comes to money, what does that mean to you? What do you think of when you hear the word speculating?
I used to think gambling. I used to think betting on like total something totally out of your control. Now I kind of think investing, at least in the way that most people are taught it. And it's very separate from savings. And like the overarching point of our discussion today, and maybe a few more episodes, is going to be that distinction between saving and investing. And so with uncertainty coming up, the best place you can be is sitting with a guaranteed access to liquid capital to take advantage of opportunities if they come up, but also to remove that aspect of risk that comes inherent to investing, aka in a lot of instances speculation, at least as it's practiced today and told to us today.
I'd say the general public, if you say like we're speculating, it's just like taking a chance. So it's all risk based. In my mind, that's the first thing I think of is it's like, hey, here's this oil endeavor, and if it hits, we can get a lot of money. Do you want to put some money down? Or here's this race. I got a hot tip that this horse is supposed to win this race. Do you want to put a bet in? Like that's speculation. You don't know anything about it. You heard about it. It could do something for you, but it has a massive risk involved. And on the other end, like you said, you compared to investing, but in the general conversation, what do you think investing is for the general public?
For the general public, if you don't put any effort into it, what investing is actually what we would call speculation. It is just throw money into the market. The market's always going to go up. You ride or die. You keep it in there for as long as possible. You don't sell when it's down because then you're locking in paper losses. You don't sell when it's up because then you're robbing yourself of future gains. You have no idea who the manager of the fund is. You don't know any of the underlying mechanics of this fund, of the companies behind them. There's no economic research. There's no balance sheet study for any of the companies that make up the fund. And typically now it seems to be, index fund or ETF is the kind of primary strategy that's pushed on us, not as much mutual funds anymore, at least in what I see. But none of that has any element of control or mastery of what you're doing. And so I think of investing actually where you deep dive and you understand and you research and you can talk credibly through why you have the investment you have, what assurances you have, what collateral, et cetera. Like investors talk starting with, the circles we're talking in now where we're trying to expose ourselves to as much, financial wisdom as possible. Like the first thing people talk about when they talk about an investment seems to be the collateral, the assurances, the guarantees. It's not just the rate of return, which when you think of typical investing as we're taught, it's only focused on rate of return. There's no discussion of guarantees or collateral because there is none, because it could go to zero. And so that distinction is something we really want to hammer home. Are you investing or are you speculating?
So investing in the broader sense, if you could whittle it down to like a couple words, what does it mean?
Thoughtful allocation of capital in a vehicle you understand with the hopes of a return and some assurances on the back end.
Like the language that's used in 2024, speculating nowadays, it just means like, hey, I'm throwing out a loose gamble and I have no idea how this is going to turn out. I've got some extra money. I'm throwing it down and I don't know anything about it. Investing in my mind in language of 2024, although we use the word investing for things that are really speculating, like you kind of just described, what it should be and what I hope it's turning back to, because it seems like people are starting to focus a little bit more on things, at least in our circles, is it's kind of like you have maybe a specialized knowledge of something that you want to put money in with the hopes of a return. It's still a bit of a risk. There's always risk involved in an investment, but you're doing it with some kind of background knowledge about what's happening in the underlying fundamentals of that vehicle that you're investing in, whether that be market-based or stock market-based, or whether that be real estate or businesses or whatever. You can invest in a million things. You can invest in a person who you think who's going to build a business, all kinds of things, but you should have some background knowledge. And the third pillar of like what people do is to put their money in is savings. And what do you think of when you think of savings? Like what are the key characteristics there?
You want guarantees and security. It's not a vehicle where you can lose money. It may or may not provide a return, but it can't lose. It has to be liquid and accessible. I mean, you could have contractual guaranteed products that we would consider savings that have restrictions on liquidity, for instance, a CD, and that would still be a savings vehicle, but there is a restriction there. So there's a lot of products that are savings products, but they don't meet all of the criteria that we would consider. But I would say guarantees, certainty, inability to lose your capital, some return for at least the entity that is sitting on the money and who they themselves are investing in.
Yeah, in our environment too. But if we're not going to get into like the whole world of the Federal Reserve and the inflationary nature of our money, I think of savings like, so it is saving to just stick it under the mattress. You're losing money if we want to get technical, you're losing money doing that because it's producing no return. The value of the dollar is going down. But I'm just talking about it's something that's safe, which it might not be under your mattress, but you're doing something in a safe way where the money can't be lost. So of those like three things, I think that the fundamental thing we should always do is save. We should always just set some money aside. We have a massive savings problem in America. We have the largest incomes, among the largest incomes, at least in the world, yet we as Americans have one of the lowest savings rates in the world. It's gone negative at different times, and that might be happening right now because I mean, if you've gone to the grocery store, inflation's up. So saving rates could be negative. I haven't looked at any data on that in quite a few months, but typically they're less than 5%. And then what people do is they do what they think is investing by speculating with their money. And we believe that we should save first. If we want to use like the terminology and the shortened versions of what we're talking about, speculating, high risk, don't know much about it. Whittle it down to investment. You have specialized knowledge in something and you're going to put your money there with the hopes and likelihood of a return, but potential for loss. There's risk involved. Saving is you're going to put your money somewhere safe, secure, guarantees liquidity, should get a return in the products in the environment you use. But the key is you don't lose.
An imperfect analogy that just popped in mind. If you think of a casino, there are investors involved in a casino and there are speculators at a casino. And if you think of what goes into building a casino, you think of the real estate transactions, you think of the insurance, you think of the collateral that the borrowers have to put up to build a casino. Just like any other, just substitute out any real estate transaction, what you have to put up and what you have to guarantee as the builder, and then you are projecting returns. You have assessed the business area, the viability of your location, bringing in people to the casino. You're going to put in a restaurant. The restaurant's going to make X return. These bars have this return. Like you've done detailed analysis on these numbers. You've gone through the work of getting the funding by putting up collateral. You've got insurance in place. You could lose, but you also put mitigations in place. Like there are investors in the casino on the side of the casino. And then you have people walking in the door who have a little bit of knowledge. Some people have a lot of knowledge about blackjack, whatever their game is, but at the end of the day, it's mostly out of their control and they're speculating. And so not a perfect analogy, sure, but if you think of what people are doing and which side, like the due diligence, protection, putting up collateral, fundamental financial analysis on one side, and then you think of I'm putting my money with the hope of a return, which side do you think most American quote investors would fall into? If you had to pick one or the other, they're not researching the funds, they're not doing deep dives on the company balance sheet. It hinges on the idea that stocks have to go up. And it hinges on the idea that that the markets goes up and down, but it goes up in the long run. And while that may be true, which group are you analogous to in the casino comparison when you are just kind of walking in, putting your money on the table and hoping you win?
Back to the gambling thing, when you walk into the casino, I just find it funny. And if you want to go do that, if you enjoy it and you want to truly speculate and you're cool with losing all your money, you can have a blast.
I love gambling.
Yeah, but the people who really walk into a casino with a pocket full of money who are investing in the game typically aren't welcome in the casino very long. I always find that interesting when somebody really knows how to play the game and wins a lot of money, they get banned quickly. It's a world of speculation there, but most people are only in the world of speculation. It's not a terrible analogy, but coming back to the way that we've defined those three words, the interesting thing is the language that's present in the world. So if we stick with those basic three definitions of high risk, specialized knowledge, guaranteed, between speculating, investing, and saving. Those don't correspond to the marketing we see. Like everybody says retirement savings, but they're putting it into a product that is sometimes called an investment, but is really a speculation because the person doesn't have any specialized knowledge on what they're investing in. So it's fascinating the way that those three things are described in the financial model.
Yeah, and I think the distinction of speculation and, remove the gambling side, spinning the roulette wheel, whatever. In talking about finances and the financial planning model, I think that the difference between speculation and investment is not the vehicle, it's the person, and it's the knowledge behind it. So these products that people are investing in or speculating in, they're still investment vehicles, right? Because that is the prospectus. It is, here's what we plan to do. We hope to achieve these returns. We may not. If we don't, there's no recourse. But this is our strategy. So there is this prospectus and there is a strategy in place. It is, the vehicle itself is an investment vehicle, but are you, as the person putting money into it, are you an investor or a speculator? And I think that is, it's subjective, but it's dependent on your own knowledge of what you're doing. So you could have two people that hold the same fund, whether it's an index fund or an individual stock, and one can be a speculator and one could be an investor based on their, people call it your investor DNA or your financial acumen. And so we want to make sure, and again, we're never saying don't invest. Our message is that we want to put the protection and savings components in first, because what good is a pile of money if it's all exposed to a lawsuit if you are found found to be guilty or you found liable in a car accident, right? If that can wipe out that whole thing. So we focus on the protection and savings component, and we grow our money from there. And how you grow it is another discussion. But we're not against investing in growth at all. We're very supportive of that. But what we want is, to the degree that we can impact you listening, is if you are a speculator, to get it to the category of being an investor. And that ties into what we talked about the last 2 weeks, which is, we're not saying, whatever the topic is, voting, vaccination, fluoride, whatever it is, like all these things we covered in the last couple of weeks, we're not saying that it's wrong to do XYZ. It's just, do your research and make an informed decision that you can support and that holds up to your own challenges. You should be the one challenging these things. It's like the scientific method is just rigorous testing of an idea. Well, in the same way, if you are doing something and you haven't ever questioned why you're doing it, whether it's in the market, whether it's in health, et cetera, you should question that. And if you decide this is still the financial vehicle that I want to put my money into, that's what you should do. But you should understand what it is and move from being a speculator to an investor.
And I even say that if you are just a pure speculator, I agree with that. But I think every American needs to get the savings component. I believe that everybody should strive for at least 25% of their income. I start with 20%. That's what I taught my kids. Like, we always save at least 20%. And then as your income goes up, you should be saving even more of that. And now when you have a pile of savings, and then you build that specialized knowledge that you're talking about, now you can invest into that thing. But the world wants us to start on the speculation side. Just put your money somewhere so that it can grow. And I'm starting to think about like language in this discussion. They also always say that so your money compounds over time, and it doesn't ever compound in a stock. It's poor language. So if we want to be deliberate in the way we speak, there's no compound interest in the stock market. It doesn't happen. You can have a dividend that can buy you more stock, and you can have an appreciation of the stock or of the asset, or a depreciation. But there's zero compounding going on.
Because the stock going up is not interest generated. A dividend being paid out is not interest generated. So at a basic level, it's not compound interest, but compound interest presumes guaranteed growth, at least in every time it's ever referenced in financial planning, when in reality, like, you can compound losses as well.
And the only two places I know that have real compound interest is whole life insurance and a general bank account. I guess to a degree a CD does, but it's not the same because it's also under certain terms, and I think it kind of fits the category, but I like to think of whole life, and just even a savings or checking account has real compound interest. Now, one of those is taxable, one of those is not, but money continues to earn on the interest earned. And that's the key.
Yeah. So when we talk about, we're kind of setting the stage for a discussion about the accumulation theory and the typical financial planning model. And we just want to talk through, like, with that basis, with a little understanding of saving versus speculation versus investment, what is the actual method that we are taught? So we want to break that down. And it's generally called the accumulation method, and compare that to the velocity of money and what we try to impart. Like, what's the base distinction there?
Well, the accumulation theory is it's what's generally pitched to the public, and it's really a more of a market-based model that is just talking about build a nest egg, invest your money with a financial institution, put as much in as you can, as long as you can, let it build, and then someday you'll have this to live off of. So you're just accumulating a pile of cash is really the goal, or a pile of whatever assets to have for later when you're no longer earning money. That's the basics of the accumulation theory. And then there's a lot of strategies and a lot of marketing ways in which the companies and the world tries to get you to buy into that. But the weird thing about it, when you talk about accumulation versus velocity, is that the people who want you to accumulate money with them aren't practicing the accumulation theory. They're practicing the velocity of money theory. So they want you to do certain things that they're not doing. And those things, we talk about it all the time. There's really four major things. I'll let you talk about it so I don't steal all the time on it.
Those institutions don't track their net worth like we do. You know, we log into our Betterment account or whatever and see what our net worth is, and that's the goal. And that's what our advisor has got at front of mind, is getting this net worth number. Well, you never hear about like Chase Bank's net worth. You hear about their cash flow, you hear about their income. Like, it's just a different way of thinking. And so what do these institutions want? They want four things. They want our money. They want it on a regular and ongoing basis. They want it for as long as possible. And when it's time to give it back, they want to give back as little as possible. What did we just describe right there? They want our money, so we provide the capital, in contrast to what it used to be, where in the pension system, the employer is on the hook for this payment. And so the risk is on them. So they have to steward their resources in order, because once you hit that criteria, whatever the pension criteria is, you're now on their payroll for life. And so imagine the blessing to an employer when you said, hey, not only can you relieve yourselves of having to provide the money, but you can also put the risk on the employee as well. And so we, as employees, as consumers, eagerly jumped at the opportunity to provide the capital and keep the risk. And so we provide the money. They want our money. That's the first one. They want it on a regular and ongoing basis. And so how have they achieved that, especially through legislation in recent years, the regular and ongoing basis part? How do they get more people into 401k plans, for instance?
Automatic enrollments. The last W-2 job that I've kicked into, it was like an automatic 3% that I didn't choose to do. It was just by virtue of being hired, 3% of my pay was going into the 401k, which is kind of wild, because you look at that, you're like, I didn't choose that. You have to go in, and for me, I had to take it away because I don't want to be in that product. Which, for a lot of people, maybe that product is good, but I like to have control of my capital rather than give it up to the person who would rather control it for me. And then on the same token, like, then they want to have it's always a direct deduction. I can't just choose to go to my 401k and say, hey, I have an extra $1,000. I'd like to deposit it into this. Now obviously I can open a Fidelity account or some brokerage account somewhere and just do that on my own. But if I want to put it into the qualified plan, I can't turn it off and on as often as I want when I have some cash and just write the check. It always has to be directly deducted from my pay, which is fascinating. It's almost like a direct wage tax, isn't it?
And we celebrate it. We brag about it. And we prioritize it.
We do. I had a discussion just, I don't know, last week, maybe a couple of days ago. Very, very short, but it was basically the buy term and invest the difference by different words, but the words came up, and it was self-insurance. Once you're in your 60s, if you've invested, you'll be self-insured and you won't need life insurance. What does self-insured mean? Let's just get back to life insurance for a minute here.
Well, it's not a thing, so I don't know what it means, but what they intend it to mean is that you just have enough capital available to fund whatever life may throw at you, whether that's a house burning down or you dying. But I'm going to guess that they only use that in reference to life insurance. I'm going to guess that they keep their homeowner's insurance or their renter's insurance. I guarantee they keep the car insurance because they have to. These are the assets that person who is bragging about being self-insured still insures are things that rarely burn down or rarely get totaled. But the one thing that's guaranteed to get totaled, the one thing that's guaranteed to end and guaranteed to pay out a claim if one exists is the thing that they would rather self-insure. So if you have $1 million house and you have $1 million, you don't need insurance, I guess. You could rebuild it from the ground up and spend your $1 million on that. And now you have replaced your house and lost $1 million, or you could have insurance. And so I don't think anybody would make that argument of self-insurance if on their $1 million house, on their retirement dream home. I don't think anyone would ever in their right mind make the self-insurance argument. I've got enough assets that I can just, if it burns down, I'll just rebuild it myself. Like, that doesn't make sense in that discussion at all, but it's very prevalent in the life insurance. And it's a misnomer because it's not really a thing. Like, the whole idea of insurance is that you're outsourcing the risk to an entity that pools that risk, uses actuarial math in order to set premiums such that they can sustain their guaranteed payouts of a much greater amount than you put into the policy. And they do that very well. And so you can't self-insure because you can't outsource that risk. You're just keeping the risk is inherently not insuring.
It is funny. And I think you described that pretty well. It's the only people I know who truly self-insure are the Amish. Very few people are living in that way too, because I promise you that your neighbors aren't going to ensure that your children are taken care of for decades and decades. Yeah, they might do a GoFundMe, and they might throw $50 at you, and hopefully that accumulates enough to do some damage if you have enough friends and family. But the Amish, they actually will truly take care of that widow and children until they're adults, unlike any other community I know of. So that doesn't really not a good parallel to American society.
And another major flaw in that plan, or lack thereof, is that it's not what we call self-completing. If you're 30 and your plan is to get to 65 with a pile of assets and be self-insured to where you don't need insurance, you have to get there. And if you don't get there, that is not self-completing unless you have insurance in place. And so they say, okay, well, in that case, we'll buy term to just bridge that gap. If I die early, we'll get the insurance. If I make it there, the insurance drops off and now I have that money. But again, you're not going to cancel the insurance on your home or your car. So to do that on your life that is guaranteed to get totaled, it doesn't track.
What if you didn't get there? Well, I'm saying if you're 65, like, what if you survive, but you didn't get there? Like, your plan was to have all this money because you were going to invest it in a speculative market, or maybe you invested in other things, but maybe things just didn't work out. Maybe you didn't accumulate the pile of money you actually will need. Now you're going to continue to work. Your family actually continues to need your income, or you need the income because you don't have enough accumulated. What if it didn't work?
Or what if you get disabled? And so the term policy doesn't pay out, but you still have to support yourself and your family without an income source. Do you have any kind of disability protection written into this plan of self-insurance, or have you become a cost to your family on top of what you have to come up with to support them while this term policy never pays out? And so a lot of these things, spoiler alert for those that are, most people listening are familiar enough with life insurance that they understand that these issues are all addressed in the way that we use a whole life policy. But yeah, it's just the self-insurance idea is go cancel your car insurance and drive down the highway, see how you feel, see how terrified you are, and ask yourself, will I do this with my life, with my health, with my house, with my car when I'm 65 simply because I have a pile of money? No, because when you're in that mode of decades of accumulating, you're not going to relish the idea of paying $800,000 to replace your house. Like, that's still going to hurt, even though you have the assets there. And when you understand the velocity of money and like what that $800,000, which goes out of your pocket in, to health bills, home rebuild, whatever it is, whatever you self-insured, once that money is out of your system, and if you understand the velocity of money and what that money could be doing for you, you're not going to want to interrupt that process. And so it's just, I don't know, it's just like a JV level of thinking. And I think so much of it stems from just people having this visceral reaction against life insurance that is pushed to them by financial entertainers in Wall Street. Because again, no one talks about Chase Bank's net worth. We're not talking about pond money here. When we talk about institutions, we're talking about a flowing river and the power that generates. We are taught to have this stagnant pond, accumulate this money that's not doing anything for us, focus on net worth. What we want to focus on now, and what we're trying to help improve in our own lives and help with with our clients is increasing that velocity of money so that you're actually doing what the institutions are that are telling you to sit on it are doing themselves.
How does life insurance fit into that? Because I talked about it as a savings vehicle, which is a little bit of pond theory. So how am I wrong?
Yeah, you're not wrong. Because here's a book by Caleb Williams, The And Asset, great quick read. This is not an either or vehicle. And the great thing, one of our contractual benefits, if you go back to our episode about policy loans, if you go back to episode 13, you talk about the policy loans and we talk about how we can still access this money. And so even though we are putting it into a savings vehicle that is giving us the guaranteed growth, we also have the contractual right of guaranteed access without reducing the principal. So in the future, if I need to rebuild my home, I have my life insurance. I have this pool of capital. If I need to access that capital, I can do so without reducing the principal. And so that principal continues to grow and compound and actually compound, unlike a stock, portfolio. It actually continuously guaranteed compounds while I have the ability to access it via policy loan. So you're not wrong because it's an and asset, it's not or.
Then I can actually do both. I can accumulate money and at the same time turn it into something that flows money through my life. I think that sometimes we get to a point where, we might have talked about this in past episodes, but we think that people inherently get that because we read so much about it. And I think sometimes it's good to just have this basic discussion of, very simply put, like the reason we think that we should save a high percentage of our income into this vehicle, this whole life vehicle, to kind of pull this all in is because it's going to protect our families in the event that we die. It's going to insure us all the way to the end. It's going to protect our income and our families from being financially devastated as well. And then while we're doing that, we have a savings component built into the whole life insurance, which is guaranteed, efficient, all those things we talked about in the savings definition. And we can also leverage that to do the investing side with specialized knowledge. So if you happen to like land deals, if you happen to like real estate, if you happen to like building and buying businesses, if you happen to like Bitcoin and you actually really understand it, you can now leverage that savings. The savings never stops growing, and also do the investing side, which starts to create the river part of that analogy and flowing that money into your life. You're actually taking care of both models at the same time with guarantees, and nothing else out there offers that. That's to my knowledge.
If you're tracking that, and we've gone through these four things that the institutions want, they want our money, regular ongoing basis. The third one, keep as long as possible. That should make sense when you understand if we want that in our lives, if we're doing IBC because we want to sit and control the capital while also flowing it and using it to grow. If we understand why we want that, you should understand why financial institutions want that. And so what do they do to put that in place? What is the gate there? It's the early withdrawal penalty. You have to keep it in until 59 and a half. And if you withdraw before then, you lose your tax benefits and you pay a penalty to get it out. So that check, that's the keep as long as possible.
Yeah, it allows us to act as the part of like what the financial institutions want. It gives us the control, and it keeps the money in our own ecosystem. They want our money. We want to keep our money. This gives us a product where we keep first right access on a contractual basis, which is so important to our money. Step 2 is you have to pay a premium. People think paying a premium is a bad thing. Paying a premium on a regular basis, whether you do it annually, quarterly, semi-annually, monthly, whatever, is an awesome thing because it's an ongoing savings. And in the way we structure this, it's going to be dollar for dollar in a short period of time, and it actually creates savings. Keep it as long as possible. It never goes away. You talked about the leverage side of that. It never goes away. That money is, even if you're accessing and using it for something else, it's still accumulating. It is always there. And it's going to, the replacement side of that will always exist in the form of death benefit. I mean, there might be a slightly reduced death benefit based on leveraged money, but it's going to increase to the point that it still replaces the money that's out. And they want to give you back as little as possible, the financial institutions. Well, we're actually going to do the opposite of that. We're going to have access to it for as long as possible, and we're going to provide it to our loved ones, our heirs, on a greater basis than what we put in, guaranteed.
Yeah, it's interesting. In the entire buildup, there's these penalties to access it. You have to let it grow. And then you hit a certain age. I think it's 73 now, maybe 72 and a half. Then all of a sudden you have a required minimum distribution where you have to start taking this money out. And so it's like, wait a second. For 40 years, I was penalized for touching this money. And now I have about a 10-year window where I can access it. at my discretion. And then we flip gears, and now you have to take it out and you have to have it drawn down if you live long enough. It's like, why do they want you to empty this account? Because they want you to put it back into the economy, and they don't want you just leaving it and passing it on tax free to your heirs. The incentive structure, it always goes back to, what do they want from this? And are they just all of a sudden, we don't think you should have this money now because we need to help you prepare for retirement. Okay, now you're at retirement. You've been retired for about a decade. Okay, now we need to help you spend this money. And if you don't take out enough money, you're going to get taxed or penalized. I think, is it still 50%?
Yeah, 50% of what you should have taken out.
Okay, now we have to fire hose this money out of your life, and you're going to get penalized if you don't get it out of your life fast enough. Like, who came up with this plan? Well, obviously, it's just what we're talking about. Like, go back to incentive. And anytime there's a negative financial incentive to withdrawing your money, you should wonder why, and you should apply those four things we've been talking about. They want our money, regular ongoing basis, keep as long as possible, give back as little as possible. Everything that you're going to do in your financial life, if you go the typical route, is going to include a negative financial incentive to withdrawing money, whether that's a IRS code where you'll get penalized if you withdraw that money, or something like a brokerage account where you're not going to get a penalty for withdrawing the money. You're just going to disrupt the compounding, the quote compounding. This money needs decades and decades to get this beautiful growth curve that's projected. Well, there is a negative financial incentive to withdraw that, because now you remove that money, not just in this moment, but for the rest of what you're projecting it will do. And so that's not just it's not like, you take out $100,000 from this portfolio. It's not like your end result in 60 years or 30 years when you retire, that your projection isn't just $100,000 shy of because that's what you withdrew when you were 30. Like, no, it's many, many times that over, because that didn't get the time to compound. So you have a not a technical negative incentive, but you have a practical negative incentive. You have a mathematical negative incentive to withdraw that money, even if it's not the government and the IRS saying that you have it. Just put that through the lens. Anything you're considering in a financial decision, put it through the lens of, what do financial institutions want, and does it make sense why I'm being pitched this, through that lens, and put that through our lens, the lens of what we're saying to do. We talk about whole life insurance, talk about infinite banking. Do you think that the insurance companies have the same financial, like, when you understand the product, these are not their four goals, because it wouldn't make sense the way that they do it. And you, as the person paying the premiums for this product and getting the usage of it, put it through the same lens and see if it doesn't stand out as the exception where everything else fits this model.
I'd say the insurance company sort of does want the first three. Like, of those four rules, they want your money. They do want you to pay your premium. They want it on a regular ongoing basis. They don't want you to stop paying premium, but different than any other product, they give you provisions to stop paying premium and keep your products in force, which is interesting. I mean, you could stop paying your 401k and keep it in force as well, but there's no guarantee on a higher payout at the end regardless, which is an interesting facet there. They do want to keep it as long as possible. They don't, the longer you live, the better off they are, because they can do more things with that money to make the company money. So there are truths there. The biggest difference is they want to give back as little as possible, and they're going to give you back more than you've ever put in. 100% guaranteed they are going to do that. So that one distinction of the four major bullet points you talked about way back, they still exist, but the answers are a little bit different.
And there's not the negative financial incentive to accessing your money. Now, you could withdraw like the way that, we would not advise that if you have a policy that you just, close it and take the surrender value, like that. In that case, you could, depending on how long the policy has been enforced, have a negative financial incentive there. At a certain point, you will still have a gain doing that. And it's not very long, the way that we structure these policies. But in general, the way that we teach IBC, and the way that it's done, optimally, would be through policy loans for accessing your capital. And that's not a negative financial incentive there. That's just a purely transactional. You get these benefits, you pay for this benefit, and you do with what you will with the capital. And so you're in control. You're the banker. And you're right. Those three of the four would apply to how they want to keep their companies strong. But it really, I guess I'll say, from the lens of what we're doing with our policies, apply that lens, and does it make sense for you going in that policy? And
I think a really important side of that, even though I kind of said like they do the same thing, the difference is that they are exercising the provisions of an agreed upon contract. And the provisions there are that like they're going to provide all the benefits laid out in your life insurance contract. And your one side of that is to pay the premium, which is all three of those bullets. So it's a unilateral contract. It's known as you only have to do one thing, and that's pay that premium. And they're going to give you all the guarantees in the contract in exchange for that. So nothing else is providing the guarantees on a contractual basis to accommodate or as a requirement of those three bullet points of getting your money and as long as possible and on a regular and ongoing basis. Like that's how they hold out their end of the contract, which is more beneficial to you than the total premium dollars going in every case, especially the way we design these and help people use it.
And tying back to the way we think about these things, you should just understand what their incentives are, and their incentives might align with yours. I mean, if you've just had money in the S&P 500 for the last 3 years, you're very happy with this, and you don't mind that they want your money. They want it on a regular and ongoing basis. They want to keep it as long as possible, and they want to give it back as little as possible. Great. That like we both, it's a win-win situation if you've kept your money and you've had huge gains over whatever time period you're in. So it's not that if you can answer yes to these 4 questions of what the institution's goals are when you hand over your money, that it's a, don't do it. It's just we recommend, or not recommend, but we teach how you can do that from a position where you're not risking your principal if that investment goes south. But again, it's not like an inherently bad thing that companies or that institutions want this. It's just know that they do and understand why, so that you approach it with a more thorough and well-researched lens, which is what we want in everything, including other topics that we talk about that aren't finance.
And if I can land the plane here, I think I would just like to say that one of the ways that or kind of the way we talk about this is that the general financial model given by the typical financial planner is to speculate first, invest, speculate, and then maybe try to build up the savings and protection. And we flipped that whole entire model on the head. We believe that you should build up your protections first because your wealth kind of comes on 2 parallel paths, and there's a protection path and a wealth path. They're not totally mutually exclusive because it only takes one massive event in your life to completely destroy all the wealth that you've ever accumulated. And even look at we'll call it the 3 Ds: divorce, death, disability. Any one of those things happens, and in this current world, 50% of people get divorced. Over 50%, I think. First marriages end in divorce. So that destroys wealth for people. If you get disabled, that destroys your wealth. It only takes one event. So we believe that, hey, provide that foundational protection first. And the awesome thing is when we teach people the infinite banking concept and we utilize whole life insurance, it provides protection against your death. It provides protection potentially against disability, and it creates a savings component. So where we're flipping that model on its head, we're going to protect, we're going to save, and that happens within the protection, coincidentally. And then we're going to use that now that we've got a good solid foundation that can't be disrupted. We're going to build wealth.
That's a good wrap up on that. So we want to keep talking about this idea, and we want to dive more into the accumulation theory and what the model kind of breaks out to be. And we have a lot more to discuss on that. But I think for this one, we can wrap this up, and we'll cover some of the other stuff in the next episode.
We'll see y'all next time.
All right. Cheers.